To kick off the session, we will be joined by Andrew Parsons, who is the founder and chief investment officer of Resolution Capital and a portfolio manager for the Net Group Investments Global Property Fund. Now, as we know, it's been a testing couple of years for the investment team in Australia, and they've had to find new ways of staying in touch with the property market dynamics around the world and the company management with whom they actively engage with. Now, the title of this particular session is said to be On the Road Again, as all of the four experienced portfolio managers have been traveling once again and getting stuck into their favorite subject matter, being global real estate. Well, on that note, I'm going to hand over to you, Andrew. I know you've got a presentation prepared for us, so take it away.
Thank you, and good morning, everyone. Thanks for your time. So quickly, just in relation to performance, what we can see is that just a market snapshot. What we can see is that it's obviously quite a distorted market at the moment. Lots of crosswinds facing investors and the economy more broadly. Clearly, geopolitical issues have accentuated the after effects or the aftermath of the pandemic. And so as a consequence, we're seeing a whole raft of different conflicting data in relation to inflation, in relation to economic growth, and in relation to bottlenecks on supply. So as a consequence, it's a very, as I say, distorted economy through this environment, leading to some elevated volatility for the quarter. The performance for the quarter, certainly, obviously, we gave back some of the very strong gains, particularly towards that were delivered, particularly towards the end of 2021. So we have seen some give back of some of that performance. But again, in light of what's been a fairly strong 2 or 3 year period, I don't think we should focus too much on the quarter alone. But clearly, again, the market has been buffeted by a number of different factors in the short term that certainly acting as headwinds for investment markets generally. In light of the other thing that, of course, occurred during the quarter, the official lifting of interest rates in the US and various jurisdictions around the world also indicating interest rates in the short term and likely to continue through 2022. So very quickly on attribution, you can see that a lot of our performance has been driven by the allocation to the US. We're overweight the US market. Frankly, we would like to see more diversification in terms of geographic diversification. We have a very significant exposure to the US, but based on the opportunities that are put to us at the pricing levels, we continue to see very good value in a number of the platforms there, the real estate platforms there. And as a consequence, we continue to have an overweight exposure to that market. In terms of sectorally, which we think is more important, our stock selection within the retail area of the real estate market delivered strong performance, particularly the likes of our US strip shopping centre exposures, such as Kimco, which has benefited from the reopening trade, if you will. Data centres also benefited performance. We basically have seen very strong ongoing demand in that area for reasons we'll talk about a little later. And our continued underweight exposure to diversified REITs has continued to benefit the portfolio. We don't see that they have a particular competitive advantage or deep value. And so we continue to largely avoid diversified vehicles around the world. Allocation, again, our largest overweight. We've got a very diverse portfolio. I should quickly mention, and you can see that we really have a balanced portfolio, if you will. It really delivers a very diverse range of real estate types. We're talking about residential, office, industrial, self-storage, select retail, healthcare. It's a terrific opportunity set, and we really have focused on the best of breed managers within those various areas. Our biggest overweight at the moment is actually self-storage, which we'll talk about in a little while. It's been generating enormous growth in rental rates as the portfolios are largely full, at least partly due to the work from home dynamic, people trying to declutter their homes and therefore using self-storage more and more, and as a consequence they filled, and the operators are pushing rates very aggressively. Again, I mentioned earlier, a very high exposure to the US market. We would really like to have more outside of the US, but unfortunately for a number of reasons, whether it's corporate governance, whether it's balance sheets, whether it's demographics, it really does make it hard for us to take a more meaningful exposure into some of these other geographies. Again, we focus first and foremost on sectors, not geographies. And geographies, it's more of a location or city compared with city, rather than a country compared with a country. So the US outcome is, as I say, it's an outcome of the opportunity set that's there and the dynamics that we're seeing in the supply and demand dynamics. As I said, Asia, what we see in Asia is unfortunately poor corporate governance in a couple of the different jurisdictions. And in the case of Japan, corporate governance combined with, of course, demographics. It's a shrinking population, which is fundamentally important when determining demand for real estate, one of the key drivers. So that explains why we're underweight to Asia. And in Europe, it's a case mainly of poor balance sheets. We didn't predict, obviously, the extent of the invasion of Ukraine, etc. But this is the problem when you've got highly leveraged balance sheets. You make yourself vulnerable to these sorts of events. Now, in terms of the dynamics of the market at the moment, they're exceptionally strong, I'd have to say. What you can see on the chart on the left is occupancy levels of US REIT portfolios, running at about 95% versus the historic average of less than 94%. Now, the significance of that is that, by and large, there's the rule of thumb, and it's a broad rule, is that if occupancy is above 94%, the landlord, or in fact 93.5%, the landlord has pricing power. If occupancy is below that, then the tenant tends to have pricing power. What you can see is that occupancy is near 20, if not at 20-year highs. And as we'll see shortly, we're not seeing an enormous amount of supply in general. And as a consequence, landlords selectively are enjoying very good pricing power. And that's particularly the case, as you can see on the chart on the right, in the area of residential, and that where we're seeing rent growth in the order of about 10%, which is driving earnings growth, given leverage, etc., at a higher rate than that expected in 2022. Self-storage, I think that number is conservative, quite frankly. We're expecting 6%, but I think that based on what we're seeing lately, that number is going to be significantly higher than that. It's just that it came after a very, very strong 2021. We thought that the growth would moderate, but frankly, it's looking like there's legs to it, so that's likely to continue. At the other end of the spectrum, you can see regional malls, which are obviously being impacted by the growth of e-commerce and increased vacancy rates, etc. That is leading to a far more challenging dynamic for that part of the market. As I said, look, at the end of the day, real estate's a supply and demand game. Demand is often harder to identify. It's obviously a little less transparency. It roughly equates to GDP, broadly speaking, but the predictability is of the constitution of that GDP, which is so important to the different types of real estate, is harder to assess. What we can identify very clearly is the supply picture. Now, what you can see in front of you there on the left is that we have got some level of increase in construction activity, but it's far from excessive. Now, the light blue or the light green, I don't know if you want to call it turquoise line that runs along the bottom of that slide, that's the proportion of the existing stock that's been added to through supply. So it's currently running at about 1.5% to 2%, which is in line with the historic average level of supply. But as I showed you previously, the vacancy rate is running at below historic levels. And as a consequence, that is really promoting a good supply picture where we're not facing a hugely excessive amount of supply which will flood the market. Coupled with that, what we're seeing very clearly is construction cost inflation. As a consequence, it's making it harder for development to come on in more substantial fashion. We're seeing delays in production due to shortages of goods, low unemployment levels, which is again mean that it's harder to source the labour to build the buildings. So it's taking longer to build. It's more expensive to build things, and that really again underpins good dynamics for the real estate outlook from a supply side of the equation. Now, this is important because at the end of the day, real estate can be a hedge against inflation, provided we see low levels of vacancy, high levels of occupancy. And if we can see those sort of dynamics, that generally means if construction costs are rising, we should see rents growing at least in line with inflation, if not more, so that we're seeing real rent growth. And clearly, we can already see a fairly low level of inflation over the last 10, 20 years, that the REITs have outgrown the inflation rate, and we think that will continue to be the case given the current dynamics, barring a major economic contraction. And that, of course, is always the thing to be mindful of. We have to see a growth in tenant demand. If we don't see that, then the demand side of the equation basically means it's hard to have pricing power. And so, that's why we're all monitoring, obviously, to see the extent of the global economic slowdown and the nature of that slowdown. One of the catchphrases that we've tried to identify what the key themes running through the portfolio: beds, sheds, and meds, or beds, meds, and sheds. Beds being largely residential related real estate, and you can see some of the positions that we have. Invitation Homes, which owns about 80,000 single-family homes, predominantly in the Sun Belt of the US. Essex, which owns apartments on the west coast of the US, and Equity Residential, which is a national residential play. Again, what we're seeing there is exceptional leasing conditions. Rents are going up at 10%. Now, we've spoken about this previously in our releases. Residential rents are a contributor to the US CPI number. So already before the recent increase in energy costs, etc., what we believe we're seeing is certainly sticky inflation numbers, because we think this condition should continue on for at least the next 6 to 9 months of elevated residential rents, because occupancy rates are very, very low and the supply picture is far from excessive. In relation to meds, basically it's healthcare related, senior housing, life science, medical office buildings. These are, again, enjoying obviously good, stable conditions from a demand perspective. In the case of senior housing, it was hit by the pandemic, but we're now seeing the demand returning, and the senior housing operators such as Welltower enjoying very strong trading conditions. Alexandria owns life science. It's basically lab space office. It's very hard to substitute lab space from work from home. You just can't obviously undertake that sort of work in the home. And so there's a very strong and sticky demand for that space. And largely on the sheds, we're talking about logistics, data centres, self-storage. We're seeing exceptional conditions in that part of the market, thanks to e-commerce, digitisation of the economy. One of our largest positions reported, or in fact, 2 of our largest positions reported in the last 48 hours, Prologis and Rexford, which are logistics plays. They are currently experiencing a market rent growth in the order of 20 to 60%. And that's what I'm talking about being a hedge against inflation. Quite exceptional circumstances from the logistics market. Self-storage, again, seeing in the order of 10 to 20% in 2021. We think probably 5 to 10% in 2022. Very strong circumstances in the portfolio. So those themes constitute around about 2/3 of the portfolio that has been so important to driving performance. I mentioned residential. I won't spend too much longer on it, but clearly it's been a massive driver of rent growth. The shortage of undersupply, which you can see in the top right, which is now driving outsized rent growth, and the work from home dynamic clearly. Now, this is a global issue, not just in the US. We're seeing shortage of residential right around the world. The meds I've talked about, again, we're seeing very strong rent growth starting to occur. And of course, because of COVID, etc., supply construction activity, is highlighted in the bottom right chart, has been curtailed, and that sets up a very strong ongoing recovery. Finally, sheds. Again, just to reiterate, we're seeing occupancy levels at extremely low levels. Rexford, which operates in Southern California, occupancy is above 99%. They basically have no vacancy, which is quite extraordinary in the logistics warehouse space industry. And as a consequence, again, exceptionally strong rent growth. Just to finish, Big Yellow, as a case study, it owns self-storage in the UK. We spent some time looking at this portfolio in the last 3 months as we've been back out touring again. Again, the work from home dynamic means that people decluttering. It is hard to get sites to build more self-storage, and as a consequence, they're enjoying very high levels of occupancy and very strong rent growth. And as you can see, with a very strong balance sheet with a loan to value of circa 14-15%, this stock is in a great position to continue to capitalise on these dynamics. So just in conclusion, look, there's no doubt that we're experiencing quite extraordinary conditions in relation to a whole raft of different issues, whether, as I say, it's the Ukraine situation, the supply bottlenecks, which has been exacerbated or accentuated through the situation unfolding in China in relation to, of course, the COVID lockdowns. And as a consequence of that, we are seeing higher interest rates. We are seeing a move from QE to QT, to quantitative tightening. And as a consequence, we do think that the market is likely to be more moderate, shall we say. And it is fair to say that multiples are elevated. So we're certainly not suggesting investors should expect extraordinary gains, but what we do believe very strongly is in the need for effective diversification. Netflix's result in the last 24, 48 hours highlights, frankly, the overheated nature of some of the parts of the equities market. The REITs are driven by long-term cash flows that are supported by long-term leases, moderate levels of leverage, robust balance sheets, and as a consequence, we don't see, given huge amounts of supply, we don't see idiosyncratic risks to REITs. In other words, the biggest risk to REITs is always around balance sheets and supply. That's the idiosyncratic risks to REITs. And at the moment, as I've said, we've seen moderate levels of supply and the cost of which is increasing, and we're seeing quite robust balance sheets. So the REITs for us are an effective part of a diversified portfolio, provided you identify the real estate that is economically relevant and therefore capable of generating pricing power to act as a hedge against inflation. So on that note, thank you. I'm happy to take any questions.
Andrew, thank you so much for that, especially, looking at the supply and demand dynamics that you were speaking about in terms of, the global property sector. We've got about a minute or so I'm going to try and sneak in a question in there. What I have noticed is that you've got a notable underweight position in the diversified sector, and from a regional perspective, Japan, which you actually already alluded to. So, I mean, this is obviously no coincidence in terms, of given the fact that the largest Japanese REITs. But would you maybe just mind delving a little bit into more details as to why you're not generally a fan of the diversified REIT structure? Maybe just high level, give us just some insights there.
Absolutely. So, look, at the end of the day, what we want is specialist sharpshooters. We think that they're capable of extracting the most from the real estate because they best understand the dynamics of the through cycle. Diversified vehicles, they don't tend to be very disciplined in capital allocation. They tend to start allocating to segments of the market when they're already in favour, and so they're late to the party, if you will, and then they don't particularly understand the true dynamics and how to best extract the returns. So therefore, they tend to generate inferior returns to sector specialists at the real estate level, and from a capital allocation perspective, they compound their mistakes through poor timing, etc. So the diversified vehicles to us, it's easy for them to say, oh, we're a diversified vehicle, we give a good cross-section of the real estate market, but frankly, it's a suboptimal platform that generates suboptimal outcomes in the medium to long term, and we've seen it time and time again.
Andrew, thank you so much for that great presentation. We're going to have to leave it at that for today. Of course, that was Andrew Parsons from Resolution Capital.